Hello everyone, welcome back to my channel. In today's video, I'm gonna share with you a strategy similar to what I'm doing with Nike, but this time it's gonna be on Qualcomm. Now, Qualcomm has such a high IB, that is the implied volatility of the stock. And it just pays premiums that are very, very good with compared to other positions that I own, such that I have been able to build on my original strategy quite well. And today in this video, I want to show you exactly how I'm doing this. Now, to give you a little background, I started back in July just with a normal diagonal spread. Where I basically bought the call auction expiring in January 2025 with a strike price of $180. Now, with respect to that, I sold the call position expiring on January 2024 with the same strike price. So if you think about it, this is just like a small capital that I'm investing, and then I'm trying to grow on that position. But the way I do that is with the income that I generate from the position itself. And eventually what I want to do with this is to be able to buy the stock itself or improve the long position so much such that it is basically a delta 1 call at that point. So if you think about it, is in a nutshell, is like paying the mortgage of a house with the rent of the house. So in theory, you should be able to pay it off the house with the rental income. That is exactly what I'm doing with this strategy here. So back in July, I started with this strategy, and today I'm sitting at a 160 call on the short portion of the strategy and a 150 call on the long portion. So you can see right away that I have been able to build a gap between 150 and 160, which basically is transforming this strategy from a diagonal spread into just a call spread. So I'm slowly changing that strategy from a diagonal spread to what will be a debit call spread as I continue with this strategy. So in today's video, I'm going to show you exactly how I'm doing this. So here is the position that I'm having right now. I have here the 150 call expiring on January 2025. And what I'm going to do is I'm going to sell that position. So that is my long portion of the strategy. So I'm selling that. And I'm going to buy back the 160 call that expires actually this week. Now, if I close this strategy, you can right away tell that I'm going to get a credit, but that's not what I'm going to do. I'm going to roll this short portion to 2 weeks out, and I'm going to be keeping the same strike price. So if I go here, I'm going to be rolling from September 20 to October 4. So that is 2 weeks out, and I'm going to be selling the 160 call. So I'm going to go down on strike, and I'm going to be selecting this call position here. So right away, that's going to give me a credit, right? So I can stop right there, and I'm just, in a nutshell, just rolling the 160 calls. But what I'm going to do is, instead of just doing that, I'm going to use that credit in order to also roll the 150 call and go down in a strike price. So what I'm going to be doing is I'm going to go down here, and I'm going to select the same expiration date, but in this case, I'm going to be buying a call, and I'm going to be going down on a strike to now $145. So you can see that based on this strategy, it's going to cost me around $29, which is a very small cost, and now the markets are close So this varies a lot when you're doing this when the markets are open. Normally it goes from a cost to a credit. So I'm trying to do it when I have a credit on the position. But you can see that the cost is very, very small. And like I said, when you're doing this, when the markets are open, it just fluctuates between a cost and a credit. So what I'm doing right here is I'm going from that 160 call. Now it's going to be expiring in October 2024. And on the long portion, I'm going to be buying the 145 call, but keeping the same expiration day of January 2025. Okay, so I'm going from this position to this position. And one thing that I want to point out here about the importance of this strategy is, as you can see, I just basically rolled this short portion 2 weeks. That's all, 2 weeks. And even though this call is in the money slightly, I still am able to collect a very good premium on the position, such that now the gap that I'm keeping in the call debit spread here is gonna be from 160 to 145. So before I was buying at 150 and selling at 160, but now I'm gonna be buying at 145 and selling at 160. So right away you can see how I am just with the credit that I'm collecting on the short side, I'm basically going down on strike price on my long position, and I am accumulating value in that way. Now, you might notice that on the long position, if I go down from 150 to 145, that is not $500. And the reason for that is because there is still some time until we get to January 2025. So I'm taking advantage of that uncertainty. As we go down more in strike price, it's going to become more costly and more costly, but also I'm going to be getting to a position where I'm going to be even more safe in this strategy, such that if the stock price drastically drops, then I'm still gonna be saving a lot of the value of this on this strategy itself. Another thing that I want to show you here is that some people might want to, instead of going down in strike price on the long position, is just extend this diagonal spread. And that is something that you absolutely can do. So for example, if instead of going to this October 4th 160 call, let's say I go a little bit farther to 1 month out, approximately to the October 25th, 2024. And I'm also again selling the same strike price. So I'm going to be selling the call, the 160 call. And instead of going to this 145 call here on the same expiration day of January 2025, I'm going to be going to a much farther out expiration date. So let's say, and I have been looking at these numbers before to save time. Let's say I go to April. Now in this case, instead of going down in price, I'm gonna be buying the same strike price. So that's gonna be 150. And you can see that here, that is gonna still give me a significant credit of $140 for making this change. And just to show you what I'm doing right here is I am rolling out the short position or the short call of this strategy. So this is the 160 short call to October 2024. 2024. That's going to be approximately 1 month that I'm rolling it out. And on the long portion, I am gonna be keeping the 150 strike price, but I am extending that long position to April 2025. So here I'm going from this position to this position. Now you can say, well, I'm not improving with the strike prices here. I'm just keeping them the same. But what you have to notice here is that on the short position, I only roll it 1 month. But on the long position, I was able to improve the expiration date of this call from January to April. That is, I'm moving the short portion 1 month to give me 3 more months worth of trading on the long position. That is something that you can start doing if you are approaching the expiration day on the long position, or if you already have built enough value on the strike price on the long position such that you just need to secure time. And so the farther you go in expiration on the long position, the cheaper it's going to be. So in a nutshell, what you have to do is you have to manage your short position and try to get as much premium as possible. But on the long portion, you have to go out as much as you can. Also, staying in the money is important. But as you go out in a strike price, in the money or out of the money, or just close to what the stock is trading at, you're gonna have the same value, because like explained in other videos, out of the money calls that are even out of the money, if they are far out in the future, they do have value still, and that allows you to continuously just accumulate premiums on the short side. Okay, so that's it for this video. Let me know if you have any questions, comments. Like I said, Qualcomm have been another wonderful position to trade in. Unfortunately, it's a dividend stock. So what I'm doing is I'm just trying to watch out for dividends. Maybe in another video, I'll explain to you how dividends affect this type of strategy. However, so far I have been able to stay with a strategy and not be under risk of exercise. And yeah, like I said, they have been wonderful. So far, it have been working great for me. It might be something that you might want to give it a try, or at least look into it. All right, so thank you so much for watching. Let me know if you have any questions, comments. I would love to hear from other fellow investors that are also passionate about options and just stocks investing in general. Thank you, and I will see you on the next one.